In this video, I'm going to break down 7 of the best growth and tech ETFs that outperform the S&P 500 ETF VOO. This isn't to say that these are replacements for VOO, but they can be solid additions to a portfolio, not just for the diversification, but to boost the overall potential returns of your portfolio. So let's get to it. First on the list is IGM, the iShares Expanded Tech Sector ETF. This fund tracks the S&P North American Expanded Technology Sector Index, which is composed of US and Canadian technology companies, as well as it includes select technology-related communications and consumer discretionary companies. So why invest in IGM? First is for its broad exposure to the tech sector and technology-related companies. It also gives you access to hardware, software, internet marketing, interactive media, and related companies, and to express a view on North American technology-related companies. Also, the index it tracks is market cap weighted, and it has a cap of 8.5% for individual stocks. The index is rebalanced twice a year, and the weight capping on individual stocks is applied every quarter, so anything above that 8.5% would get distributed to other holdings in the index. Let's talk about the portfolio of IGM. So this fund contains 279 holdings in total. And the top holdings are in companies like Apple, Nvidia, Microsoft, Broadcom, and more, which make up a little over half of the percentage of the fund. The benefit of this expanded tech fund is that it has companies like Google, Meta, and Netflix, which you won't normally have in a tech ETF. For the sectors IGM is mostly exposed to, it's going to be technology, then a smaller chunk of communications and consumer discretionary, which you can see in the variety of industries that it has exposure to. For the fees, IGM does come in a little bit high with an expense ratio of 0.39%, costing $39 for every $10,000 invested. Shifting to the performance, IGM has had 5-year annual returns of 22%, and annual returns of 22% as well over the last 10 years. So some really strong results that it's been putting out. And if we compare the last 10 years to the S&P 500 ETF VOO, IGM more than doubled the returns of the market over that time period. IGM is a standout for tech sector ETFs with its addition of stocks from communications and consumer discretionary sectors. Because of this, it has provided strong performance along with beating out some of its tech ETF peers in more recent years. For investors looking for a high-growth tech ETF with a little bit more added diversity, IGM is one to check out. Next is MGK, the Vanguard Mega Cap Growth ETF. MGK tracks the performance of the CRSP US Mega Cap Growth Index, which includes companies that together make up about 70% of the total value of the US stock market. The index methodology uses a variety of growth factors to choose stocks, such as the following: future long-term growth in earnings per share, future short-term growth in EPS, 3-year historical growth in EPS, 3-year historical growth in sales per share, current investment to assets ratio, and then last, return on assets. The index stays up to date with its holdings as rebalances and reconstitutions are done quarterly, so every 3 months it's being refreshed. That brings me to MGK's portfolio, which this fund holds 66 stocks in total, and it has its top holdings in Nvidia, Apple, Microsoft, Google, Amazon, and more. And these top holdings make up about 66% or so of the total weight of the fund. As for the sectors, MGK is primarily exposed to technology and consumer discretionary, with much smaller percentages for the other sectors. Getting to the cost, MGK has an expense ratio of just 0.07%, costing you $7 for every $10,000 invested. And for the performance of MGK, this ETF has annual returns of about 19% in the last 5 years and a little over 18% in the past 10 years. Some great returns is provided in this bull market. And if we throw in the returns of VOO over the last 10 years, you can see that MGK has managed to do very well compared to the S&P 500. MGK has shown that having a concentrated portfolio of some of the largest and most successful companies can provide some really solid potential returns. Like any fund that leans heavily on the tech sector or tech-related industries, there will be higher volatility and risks that come with the opportunity for more growth. But if you're okay with this fund's concentrated portfolio, along with the fund strategy and how it chooses stocks and rebalances quarterly, then this could be a growth ETF for you to look into. Third up, we have qtum, the Defiance Quantum ETF. This ETF invests in global companies that are involved in quantum computing and machine learning, and it tracks the Blue Star Quantum Computing and Machine Learning Index. The screening for this fund only includes companies that are active in the quantum computing or machine learning business. For quantum computing, that would be superconducting materials, applications or algorithms built on quantum computers, and also equipment and materials that are used in the manufacturing of quantum computers. For machine learning, that includes advanced computing hardware, semiconductor manufacturing equipment, and companies and software that specialize in perception, collection, visualization, or management of big data. Aside from the screening, the stocks must also pass a few market cap and liquidity criteria, along with generating at least 50% revenue from quantum computing or machine learning. For the portfolio of qtum, this fund contains 78 holdings in total, and its top holdings are names like Tower Semiconductor, Micron Technology, AMD, Intel, IonQ, and more. The sectors that this fund is mostly exposed to are technology, industrials, and communication. One thing to point out here is that this fund is not a 100% pure quantum computing fund, as it has a mix of tech, semiconductors, and quantum adjacent companies. For the fees, this fund has an expense ratio on a little bit of the higher end of 0.40%, costing $40 per $10,000 invested. This fund doesn't disappoint in the returns, as it's had annual returns of the last 5 years of just over 29.5% and annual returns of nearly 25% since it was created in 2018, just over 7 years ago. And relative to the S&P 500, qtum in the 7 years that it's been around has more than 2x the overall market. For those investors looking to get some exposure to quantum computing and AI infrastructure, this fund provides a nice opportunity. We're in the early stages of a new technological era with the advances in AI, machine learning, and quantum computing coming to the forefront and gaining some traction. Now, of course, this doesn't come risk-free, since the future and true potential of quantum computing is not certain or even 100% clear yet. But it could be a safer approach to getting exposure with an ETF like qtum rather than trying to pick individual stocks, as losers will be weeded out and the winners will have higher weights over time. Next up, we have grny, the FundStrat Granny Shots US Large Cap ETF. This ETF is an actively managed fund that seeks long-term capital appreciation by investing in US large cap stocks. And it invests at least 80% of its assets in large cap US companies, which they label as companies with a market cap of $10 billion or greater. This fund has a unique approach when it comes to its stock selection. It combines a top-down fundamental analysis and bottom-up quantitative screening process to select between 20 and 50 holdings for its portfolio, which is represented currently by 7 core investment themes, and the number of these themes can vary over time from between 5 and 10. The themes are also divided into short-term and long-term macroeconomic drivers. Short-term themes, which tend to play out over 6 to 12 months, include seasonality, PMI recovery, and style tilt, while the long-term themes that span 3 to 5 years are energy and cybersecurity, millennials, global labor suppliers, and easing financial conditions. And each of the holdings must fall into at least 2 or more of the themes to be considered for the fund. Now that we talked about the strategy, let's get to the portfolio. So grny contains a total of 42 holdings, and the top companies that make up the fund are names like Costco, Netflix, Microsoft, Meta, and more. And you can see the percentage amounts are very similar, and that's because the holdings are equally weighted and the holdings of the portfolio are rebalanced quarterly. For the sectors it's primarily exposed to is technology, then industrials, financials, and consumer discretionary. For the fees, this fund will shock some of you, but it comes with an expense ratio of 0.75%, costing $75 per $10,000 invested. which is going to be because of the active management approach that the fund takes. Onto the performance, since GRNY is still fairly new, it has a short history of returns, but since it was created around a year ago in November 2024, it's had total returns of 22%, which is very solid. And if we compare this to the S&P 500 over the short time period, you can see that it's been outperforming the market by a decent margin thanks to those holdings. Although GRNY has a structure and strategy that's a bit more complex, it provides a concentrated, strong conviction portfolio that's built on themes that seem to align with the future landscape. And if you believe in the themes that this strategy lays out, along with seeking out a fund that can provide outsized gains compared to the overall market, then this is an ETF to take another look at. Next on the list, we have VONG, the Vanguard Russell 1000 Growth ETF. This fund tracks the performance of the Russell 1000 Growth Index, which is mostly made up of large cap growth stocks. And there's a few key screening criteria. The index includes those Russell 1000 companies with relatively higher price to book ratios, as well as higher IBES forecast medium-term growth and higher sales per share historical growth. And the index is reconstituted annually to ensure that new and growing companies are going to be included. For the portfolio of VONG, this fund contains 391 stocks in total, with its top holdings in familiar names like Nvidia, Apple, the other Mag 7 companies, Broadcom, and Eli Lilly, which make up nearly 60% of the portfolio's weight. And for the sector exposure, technology makes up the largest chunk, then consumer discretionary, industrials, and a few others. As for the fees, like many Vanguard funds, you have a low expense ratio of just 0.07%, costing you $7 yearly per 10K invested. VONG has had some solid performance over time, with 5-year annual returns of right around 19% and annual returns of 18% over the last 10 years. Comparing this performance to the S&P 500, VONG has made quite the gap with great results over the past decade. VONG could be a solid ETF choice for those investors that are looking for a diversified fund that leans into growth and mega cap technology companies. On to the next fund, we have SMH, the Van Eck Semiconductor ETF. This ETF follows the NVIS US listed Semiconductor 25 Index, which tracks the performance of companies that are involved in semiconductor production and equipment. The selection criteria for this fund has 2 requirements to be eligible. First is that the companies must generate at least 50% of their revenues from semiconductors. And second is that stocks must have a market cap of at least $150 million. And this index is reconstituted twice a year and rebalanced every single quarter. Shifting to the portfolio of SMH, this fund holds about 26 stocks in total, with its top holdings in Nvidia, Taiwan Semiconductors, Broadcom, Micron Technology, AMD, and more. Unlike the tech and growth funds in this list, SMH is an ETF that's focused in just one industry, so it doesn't have many stocks since it's so much more concentrated. With that being said, nearly 75% of the weight of the fund comes from these top 10 holdings, so price movements with any of these companies can have a noticeable impact on the fund. As for the cost, SMH comes in with an expense ratio of 0.35%, costing you $35 for every $10,000 invested. What really makes SMH stand out is its performance, and this ETF has had annual returns of nearly 34% in the last 5 years and just over 31% in the last 10 years. So it's had some really impressive results. Seeing what this performance looks like compared to the S&P 500 over the last decade, SMH has had some ridiculous returns to say the least. While SMH is very concentrated and less diversified than the more broad growth funds and tech sector funds, it's provided some amazing returns over the last decade and potentially for years to come. If you're an investor that has conviction in the demand and future growth of semiconductors, artificial intelligence, and AI infrastructure, then this could be a nice ETF to add to your portfolio. Next, we have SCHG, the Charles Schwab US Large Cap Growth ETF. SCHG tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which is made up of large cap growth companies. And the selection criteria for this index is based on 6 measures, 2 projected 2 current, and 2 historical. This includes projected price to earnings ratio or PE ratio and projected earnings growth, price to book ratio, and dividend yield, then trailing revenue growth and trailing earnings growth. Also, the index is market cap weighted and it reconstitutes annually in September, and the index is rebalanced quarterly. Jumping to the portfolio of schg, this fund contains 197 stocks in total, with its top holdings in Nvidia, Apple, Microsoft, Broadcom, and others making up a little over half of the portfolio. And schg's sector exposure mainly lies in technology, communication, and consumer discretionary, with the remaining in a handful of other sectors. schg has a pretty low expense ratio of just 0.04%, costing $4 yearly on every $10,000 invested. Getting to the returns, schg has done very well with 5-year annual returns of 19.5% and 10-year returns of about 18% annually. Comparing the returns to VOO over the last 10 years, schg has had an impressive run so far. If you're looking for a growth fund with solid historical performance, a diversified portfolio of large cap growth stocks, packaged together with a low fee, schg is definitely one to consider. And if you want to learn about 5 high growth ETFs that crush the S&P 500 and QQQ, then check out this video here. Or if you want to see the 6 best ETFs to combine with the S&P 500 ETF VOO, then watch this video here. As always, thank you so much for watching, and don't forget to like and subscribe. Keep on investing, and I'll see you in the next one.